So we have two primary subject areas that remain in this class: futures contracts and real estate. And then you can go on your way being juvenile financiers, ready to make your moves. We start with futures contracts. This is relevant because of their impact upon ETPs, especially. And so if you've read the futures chapter, you'll see that it's a fairly simple topic so long as you understand the process that's called daily settlement. If you understand daily settlement, you understand just about all there is to know about futures contracts. But the interest to us in that chapter is found in the appendices, because the appendices talk about why ETPs that are secured with futures contracts sometimes don't track well. And so we want to emphasize that when we get to it. In fact, the second lecture is entirely on that subject. So we'll spend our time today getting ourselves acquainted with futures contracts, trying to understand them, look at some examples, and then we'll move into the more esoteric material when we come back on Thursday. This picture on the front is kind of a joke that we start with. This is actually an incident that happened way back in the early days when these markets were moving from open outcry with physically kept records to electronic exchanges. And this was actually given to me by a student who went on to be a trader, whose name was Anatole Payne. And he found this and showed me the article. I've almost entirely forgot the story. This is an old story. But as you can tell here, looking at the coding there on the left, it looks like it's probably XML. That's what XML looks like. And physical delivery code was set to false, but there was something wrong with the code, and the code was binary, should have been a 0 and was 1. And so apparently they tried to deliver those barges of coal to some residential address on the Thames River. And this is the picture taken from off the dock. And that was just a sort of amusing story about early screw-ups in the futures markets. You got to be careful when you trade crude oil, because you don't want 10,000 gallons of crude oil delivered to your front door by an Amazon Prime truck. That's not likely to happen, actually. I did distribute this exam distribution separately because I couldn't give a lecture last time I had laryngitis, which hasn't entirely disappeared, so I hope I make it through this lecture. But you saw this. It's similar to the first, where about 50, I think it was 56% of students who took the exam, of those who had already taken it. There were some makeups to be taken at that time. That's still true. The makeup's being given tonight. There are 221 students, so about 56 got an A or an A minus, which is where I kind of want to see it. Quite a number of students take this course pass-fail, so the number of A minuses as a percent of graded scores is probably 70% or so. Although some people who take it pass-fail end up getting A's and A minuses. The distribution wasn't too surprising. There were way too many down there in the below C minus category, but that always seems to happen on the second exam. People just kind of ease up a little bit for whatever reason. And we have this sort of disaster that usually results in some cases, drop course, in other cases, pass-fail, which is, of course, not a penalty of any kind for anyone. It's fine with me if you take the course pass-fail. But, of course, I kind of know why this happens. Students come in and talk to me a little bit about it, and I say, well, did you look at any of the lectures? They said, no, I rely entirely on the reading. And I said, well, that's why you missed this question here, because I have certain questions that are taken only from the lectures, certain questions taken only from the reading, but the bulk of them taken from both. But of course, also in the lectures, I give emphasis on what I'm going to ask about. So if you don't get the lecture, then you don't hear that discussion of emphasis. One of the giveaway questions, by the way, was one where almost all of you got full credit. It was only 12-point question on the exam, and that was the one where we said discount premium, what trades at a discount always, that's a bill. What can trade at a premium or a discount, that's a note and bond only, and all that. So most of you got that entirely correct, but a sizable number of people missed almost the entire thing. And that means, of course, you didn't hear the lecture where we went through the explanation about those appendices, about why the coupon rate differs from the actual auction rate and how that's accommodated. So if you didn't hear the lecture about that, then you would know that bill is always discounted, that in the bottom note is sometimes discounted, sometimes at premium, but never at par. And so the composition of those exams, the Dutch auction questions, stuff like that, kind of tell me, where people are falling short and how. So anyway, life goes on, and then we have the one remaining exam, the final. It has the same weight as the other two, is not cumulative. It covers only the material that we're beginning with today and real estate, and is the easiest of the three. So in terms of at least the way the grades turn out. So this should be downhill for most of you. All right, let's get on to the discussion of futures contracts. On this, please remember I did add 5 points to your numeric score to compensate for a couple of questions that had rough wording. Futures contracts, similar to options, but very different in some respects, allows a trader to undertake a contract to accept delivery or to make delivery of a commodity or some kind of financial asset in the future on a known date, or in a range of dates, that maybe should say, under specified conditions and for a price contracted today. So you'll say, I'm going to take delivery of 1,000 barrels of oil in March of 2020, and let's arrange for the price today. That's what a futures contract does. The party to the contract who is agreeing to take delivery is long in the position, whereas the party who's agreeing to deliver the commodity is short in the position. Speculator will benefit when she is long if the price rises. She will benefit if she is short and the price falls. So long position reacts to rising prices positively. Short position reacts to falling prices. Retail traders nor professional traders are not inherently on either side of this position. You're as likely to be short on something as you are long on something. And unlike stocks, where the bulk of traders, of course, are long on stocks and very few people actually short stocks, this is different from that. This is like options. You might as well be long as short. And through the submission of bids and asks, the exchange will match long orders with short orders as they do on options, either with outside traders or with their own trades. So there's a market-making mechanism in the futures markets. The pricing mechanism is identical to what it is for stocks and options, which is to say limit orders are submitted. There's bid-ask queues. They work exactly the same way as they do for stocks and options, and therefore the market is cleared by those mixes of limit orders as before. Now, the best way to understand a futures contract is by example. In the chapter, I begin with the predecessor for the futures contract, the so-called forward contract, and I discuss its link to power purchase agreements in the solar energy industry, for example. And that's a subject I don't cover in the lecture. So on the exam, if there's a question about forward contracts and people miss it, I know they didn't do the reading. So let's take a look at an example. And the examples, as always, are current and they're based upon real prices. On November the 11th, 2019, when I made up either this example or used it for the book chapter, you could have agreed to pay $56.74 per barrel, and a barrel is 42 gallons, for 1,000 barrels of light sweet crude oil with a sulfur content of 0.42% or less, which is how light sweet crude is defined, for delivery at an agreed time during the month of December to a facility at Cushing, Oklahoma, free on board. And so when we say at an agreed time, that means it's an actual telephone style contract where you say, I want this oil to be delivered sometime on the 13th of December. And the other party says, okay, that's fine. And the oil delivery, by the way, is entirely by pipeline. So you have to have access to pipeline to be able to actually make or take delivery of this particular contract. This contract is traded at the New York Mercantile Exchange, which is now part of the CME Group, one of the many futures exchanges in the United States. You can speculate or hedge in this contract without taking delivery, and in most cases you don't take delivery. Again, you offset before delivery is made. You're typically not in any position to take delivery. You can't take delivery of crude oil, for example, unless you have access to pipelines that go into Cushing, Oklahoma, and unless you have storage capacity in Cushing, Oklahoma. So only if you're a large oil trader can you make or take delivery. But anyone can trade the oil contract, including you. You just make sure that you're out of the contract before its last trading day. Well, your broker will push you out of it at the last trading day if you're unable to take delivery. Now, here's some key terms that pop up that will get out of the way right off the bat so I can use them. The spot price, that term spot, refers to the price now of that product on the regular market. So the spot price of crude oil is the price currently today in Cushing, Oklahoma for the delivery of crude oil. The futures price is, of course, what we're talking about in this set of lectures. It's today's price of a specified futures contract, such as the December 2019 NYMEX light sweet crude contract. The expected future spot price, which is the price you expect today for the spot to be in the future, means exactly that. That's your sense today of what the spot price will be, let's say, in mid-December. That price and the futures price are not the same price. And for reasons that we'll understand after we look at the appendix, they're not going to be the same price. Very seldom are they the same price. And that they are different actually is going to matter a great deal. But right now we're just looking, what does that term mean? That's what we think the spot price will be in mid-December. That is not necessarily the same as the futures price for the December contract. The volume is the number of contracts traded today as represented on an exchange, as it always is. Open interest is the same as it is for options. It's the number of contracts that are open, that exist right now, that have matched long and short positions. And as was the case in options, there's no actual linkage between a short position or a long position in futures contracts. Obviously, when you entered into a long position, that was the consequence of a trade with someone that had an identical size short position, but after that, those two parties are never linked together again, and they're not actually in any meaningful way linked at the time that transaction's done. It's just the bid and ask are satisfied, and the paperwork starts for both parties. Yeah.
Does volume also include the amount that are written on the day?
No, volume is simply the amount of the trades on that day as measured by number of contracts. So if you see a volume of 6, that's 6 1,000 barrel crude contracts. E-mini contract, this should also say E-micro contract because that has just been created and now exists. I should change this actually, is a much smaller contract in some commodity, always electronically traded. Now that latter comment means that some of these markets are still traded as open outcry on the floor of the Chicago Mercantile Exchange, for example. Some of them are, the bigger, more famous contracts are done that way. Electronically exchanged simply means that there's no human involvement in it, and it is instead electronically traded. Many of the contracts, as we're going to see, I might as well say it now, I'll say it more than once, do not even have delivery conditions. They go up to the last trading day and then it's settled at that time and the contract is exited. There's no means to make or take delivery on those contracts. Increasingly, futures contracts are of that variety, but many of the old traditional contracts are still deliverable. And crude oil, the one we're using as an example, is still deliverable. There's a futures contract for just about anything you can dream up. There's all of the energies, oil, gasoline, diesel fuel, heating oil, natural gas, and ethanol. Strangely, at the time, there's none for any type of jet fuel. For the foreign exchange, there's all of the majors, the euro, pound, the yen, the peso, and almost all of these are traded in dollars Some are traded in these own currencies, not involving dollars, like there is a big euro to pound contract. And as the book says, those are called crosses if dollars are not involved. Interest rates, that's a fairly limited number of interest rate futures compared to how many interest rates there are. And they're almost entirely in dollars and euro. Various indices, such as the S&P 500, yet again, that's the oldest of the financial futures contracts. It's almost always the most heavily traded contract. That's called SPX. And the trading in the S&P 500 futures contracts is conducted on an absolutely massive scale every day. We have metals, aluminum, gold, palladium, platinum, copper, silver, and uranium. Every kind of agricultural commodity you can think of, or some are missing. Corn, wheat, soybeans, rice, coffee, oats, cattle, hogs, pork bellies, cotton, lumber, so forth. And even exotics, you can trade futures on weather. And in particular, you can trade futures on heat. You can trade futures on Las Vegas heat, for example. And we'll figure out how you would do that in the next lecture. Okay. Basically, you'll notice when we go through these discussions of the institutions, we start out by saying once there was many, then there was a few because of mergers, acquisitions, and consolidations. This is a grand example of exactly that. There's basically two major exchanges operating anymore today. That's CME Group and ICE. And they used to be the Mercantile Exchange, the NYMEX, Chicago Board of Trade, CBOT. CME was an exchange by itself. The New York Board of Trade, NYBOT, traded things like coffee and the like. And then in 2007, the first three of those were merged into CME Group. And then Globex was created and extended as an international trading arm of CME Group. And then the huge ICE bought NYBOT in 2007, and they compete with CME Group. And they are exclusively electronic trades with no deliverables. And they trade energy futures through the London market and many foreign exchanges and some trades in the United States. Now, romantically, these exchanges used to sell seats, and Chicago still does, allowing members to trade on the exchange floor. That's called the pit, and that's where you see all of these movies about guys wearing strange colored jackets, orange jackets and green jackets, waving their hands around and screaming and yelling at various prices. That still goes on every single day in Chicago for the major trades. And that's an open outcry system that still has some use and is still being practiced by many. And it's similar to that used to be used on the New York Stock Exchange, but it's being replaced slowly by electronic trading, where no humans are involved. It's just a submission of your limit orders through the bid and ask queue, basically electronic routing, and ICE is now 100% electronic. The trades are cleared through clearinghouses. That's just the bookkeeping system that makes sure that all is well at the end of the day. And a clearing member is a market maker who assumes that all trades are matched or matches it themselves. So market makers, as always, play a role by intervening in the market, making some representation when the market is there. And this becomes critical during times of crisis. It also becomes critical as these contracts wind down on their expiration date. That's when the members are very heavily involved to make sure that cleanly you get a smooth exit from the system. And it works very, very well. Here are some websites you can peruse. You should take a look at the CME Group because it kind of shows you what the representation of all of this is, how the prices are set up, things you need to know like the margins that I'll talk about here in a little bit, and the contracts that are available, price ranges, graphs, and all that stuff. So the CME Group is the one that we draw most of our data from. If you need a site for checking prices globally, iknow.com is a very good site for that. I use it a lot. And then if you trade gold, Kitco is where you go to even physically buy gold if you want. You can order bullion bars off of Kitco, and they'll deliver it to your dorm room if you are given authorization to be a trader, which requires you to submit some paperwork. So take a look at the CME Group if you have a chance, and you can kind of see the structure of what one of these sites looks like. This is a typical chain. This is for copper we're looking at here. And so like the options change, you can see, well, we have a lot of expiries. For some of these, we only have quarterly expiries. Some of the older, less popular options like sugar. Well, sugar may even be monthly now. I'm not sure what sugar is, but copper, as you can see, has monthly representation. They have a November, December, January, February, and so forth price. This chain goes monthly to December 2021, and then periodically until September 2024. So you can do a futures contract in copper in 2023 if you want. If you have some reason that copper is going to rise and fall in value and you want to speculate, or more specifically, if you're using this copper contract to hedge a copper position because you're in the business. And these are very heavily used as hedges. You can see the pricing conventions there by the pound, $2.63 a pound for November. You can see that the prices, of course, are not uniform. They vary every month a little bit. And sometimes you'll see examples of where they rise over time, fall over time, or are relatively constant. So this is what the future market starts to look like. Every Sunday night, as I point out in the course outline, anyone who follows the stock market seriously looks at the futures market Sunday night or Monday morning before market open, because the futures markets will tell you where those markets are going to open for the day, and they're fairly accurate. So I go to the CME group on Sunday night, every Sunday, and I look at the price of crude oil futures, which the day I was looking at this is probably from about a week ago or so, was 57.25. I look at natural gas because I trade natural gas fairly frequently. And then, of course, I look at the stock market. The E-mini S&P 500 tells you whether the market thinks the futures market thinks the Dow is going to open higher or lower, and it's fairly accurate. You have another one for the E-mini Dow. I'll explain the E-mini part when we get to the contract definitions. There's one for the E-mini NASDAQ 100 and a couple of overseas market like the Nikkei. The Nikkei is always looked at by people because that market's still open, or is open, I should say, on Sunday night and operational. So you can see what's going on in Asia, because what's going on in Asia is often followed by Europe, and then that's followed by the United States. So let's take a look at some of the contract examples. You know, I meant to bring a bottle of water with me, and I didn't, so I need to get some water because my throat's already getting dry. Give me about a minute.
Oh, you're bad, like,
I know.
you don't get.
I don't even understand what's happening.
So, the CB is actually this group of super spies.
Oh, right.
And what they do is they go around each of the ETFs and rob them. And this is how much they robbed for the year 2013.
$95.
Yes, $95 light sweet crude, which is light sweet crude is actually a very tasty oil. Crude oil, it's very light body, sweet appetite.
All right, like
And
$3.57
yeah,
for gas.
so they're very dangerous.
Yeah.
No one knows about it.
I can see that's a lot of money.
Yeah, so you're basically calling it now.
I just realized this is the only talking I've done in about 3 days, aside from yelling at my 1-year-old grandson Thomas to not turn on the hot water. Every single time he crawls into our bedroom, he crawls into the bathroom and stands up in the bathtub, defiantly looks at us, grabs the hot water handle, and pulls it on, right? So we'll yell at him to turn it off. So this happens about 100 times per weekend. So that's one of the reasons my voice is out, I guess. So here are just kind of a representative sample of the sizes of these contracts. And prices now compared to 2013. They don't really mean anything. They're just up or down. You see we have a light sweet crude contract, which we're talking about right now, the 1,000 barrels. The big natural gas contract is 10,000 decatherms, or MMBTUs. That's a big contract, and that's when I trade a lot. And its price in 2013 was $3 per 57 cents per decatherm. Now it's a little on the low side at $2.59. Wheat, 5,000 bushels. Oats, 5,000 bushels. And you can see that the oat pricing convention is strange. The 2013 price I have in decimals, but it's not quoted that way. It's quoted in 30 seconds. And a lot of the contracts are still quoted in 30 seconds. So a 300-6 means $3.630. And often you'll see it's just for traditional reasons that they're quoted that way. 112,000 pound sugar contract. And now when we get to the indexes, we talk about the indexes a lot in this class, because if you trade markets as a whole, probably the best way to trade them is in the futures markets rather than SPY or something like that, because of the leverage you get. But you see we have a couple of S&P 500 contracts. We have the E-mini and the traditional old contract, the S&P 500. And they are calculated as, in the case of the S&P 500, 250 times the value of the index. That's the notional value of the contract. And that's a bit confusing. What do you mean the notional value of the contract? Well, that's the monetary value of a single contract, and it is equal to, mathematically, 250 times the S&P 500. The smaller contract is 50 times the S&P 500. And to understand that's essential, and so we'll backtrack here in just a moment to make sure you do understand that pricing convention. When you get to contracts like FX, it's usually some amount of a foreign currency priced in dollars. So the huge euro-dollar contract is $10,000 worth of euros. That's the size of the contract. And in 2013, that was $1.34. Now it's $1.10. I don't trade that contract very much right now, but I am trading the British pound very heavily. And I have a really large position right now in the pound short. Gold, 100 troy ounces. Copper, 25,000 pounds. So you can see by the size of these that the traditional contracts are really large contracts. So you say, well, that's not really for the small trader, because obviously 100 ounces of gold is an awful lot of gold, given that gold is currently selling for $1,471 an ounce, or was at the market close yesterday on November the 18th, or I guess it was today. This is when I wrote this down. But we'll see here in a minute that that doesn't mean you can't trade it just because the notional value of the contract is very large. This is just meant to be an introductory representative example of what some of these contracts look like in terms of their size. Now let's stick with crude, because crude oil is easy to understand. It's a traditional contract, very heavily traded. The price history is interesting, and it's easy to describe what these futures conventions come from by looking, by example, at that contract. So this is the price history of the December 2019 light sweet crude oil contract, sometimes called the NYMEX contract, on November 13th, 2019. So this has a December expiry. This has about a month to go before its expiry, although its last trading date, as we'll see later, is going to be only in about a week, on the 20th of November. And you can see it's had a fairly volatile price history, hitting a high of 62 and a low of, well, let's see, looks like about 51 or so, which isn't unusual. This is a volatile contract. And when this was captured on the 13th, then the price was 57.28. I think that number is, and it's about the same right now. Yeah, 57.28 on 11/13/2019. The spot price was close, wasn't exactly the same, was just a few cents off. And this is one of the contracts. Now here we see it is the first of the contracts listed in the chain, although you may not be able to see that. So we're referring to the top contract there, the December 2019. The last won't be exactly the same because the price changes at every moment. So if I take a capture of the screen at one moment and then the chain a few minutes later, the price will be off by a few cents. But you can see going on down the line that this is a very stable contract, which is actually quite unusual. The current price is 57.26. If we go down to the very bottom to the December contract, we get to 53.80, and so this is in what they call slight backwardation. The contract prices are going down. So if you wanted to go long on a December 2020 contract, the price, had you maintained an order and got the order executed at market, would have been somewhere around $53.80, which is $4 below the current price right now. So this tends to indicate that the consensus on the direction of oil is downward. Now, a lot of times that consensus is proven wrong, but that's the consensus at any given moment. It's a sort of reliable indicator, or one of the better indicators for commodity inflation, where people think that's going to go. So we can trade any one of these contracts that we want, so long as we are satisfied with the price. But what is the contract? What do we need to know about it? So there's 2 slides that tell you everything you must know about any contract before you trade in it. So you say, well, you know what, I know a lot about natural gas. I know that natural gas is very cyclical. I know it's extremely volatile. It ranges in price between about $2.50 and almost $6 per decatherm, and that it can swing through that range in a period as short as 3 months. It's hugely leveraged, like 20 to 1. So if I knew what I was doing, then I could make a lot of money on this or lose a lot of money on this, depending upon how good my trading was. So what do I need to know about natural gas contract to actually enter into a single trade? Well, here we're asking that question about the crude contract because we're using that as our example. So as we already said, this contract is for 1,000 barrels of oil. And so that's 42,000 gallons of crude oil. This is light sweet crude, so it meets that sulfur definition. And when we see the pricing, it's dollars per barrel and is now CME Group. So you look there to find the price. That used to be NYMEX, but NYMEX was swallowed by CME Group. And then we introduce ourselves to 2 very critical components that you need to understand right off the bat. Otherwise, you don't know anything about futures, and that's initial margin and, on the next slide, maintenance margin. The most important of these 2 is maintenance margin. Okay, the initial margin is how much cash you have to have available in your account to enter into a single crude oil futures contract, long or short. So as you have in any trading account, like at Interactive Brokers is a very good brokerage for trading futures. You have your cash account, which is whatever cash you have that's not committed to a trade. So you say, well, I want to go short in a futures contract because I think the price of oil is going to continue to fall for whatever reason you believe that. And I wonder what it takes for Interactive Brokers to allow me to trade, other than permission to trade futures, which you have to ask for, which, by the way, is automatically granted. They fill out this long form. They ask you about your trading experience. It doesn't matter what you say. At the end, they say you now have permission to trade futures. You have to have $4,400 available cash in that account. And even though that cash is not used to buy or sell the futures, it is sort of locked up in the account and it can't be used for anything else. It's earmarked as being unavailable for anything else as long as you're in that contract, long or short. So that's what's required to get into this contract. So you say, oh, this contract has a notional value of almost $60,000. It's a 1,000-barrel contract, and you just said oil is about $58 a barrel, so it's notional value $58,000. So you're saying to trade this, I only need $4,400. That's right. That's the kind of leverage you potentially can get in futures contracts. You need $4,400. Then the maintenance margin, which is actually more important, is $4,000. And that means that the cash commitment to this contract can't go below $4,000. You can't lose the cash. And so you say, does that mean you can't take money out of the account? No, because as we're going to see when you trade futures, that every single day the cash account in your account changes the cash amount in your account changes by virtue of daily settlement. And if daily settlement pulls the balance of the cash account below 4,000, you get a margin call. You don't understand that yet, but by example here in about 15 minutes you will. Okay? So this initial margin and maintenance margin will become critical to understanding how futures contracts work.
What is the maintenance margin? What is the maintenance margin again?
They're just values that have to be present in the cash component of your brokerage account. So we'll look at an example on my account here in about 5 slides, okay? Anytime you open an account, Interactive Brokers or TD Ameritrade, you put cash in the account. Thereafter, there's always some cash in the account. Even though you buy stocks and whatever, there's still some cash in the account. That cash balance is used as the foundation for establishing whether you meet the initial margin when you make the trade on the first day and the maintenance margin to maintain the position thereafter. You need to know the last trading date, and sometimes it's very easy, but on these older contracts, not so. The last trading date for the crude oil contract is on the 3rd business day prior to the 25th day of the month in the preceding month of the contract. And you don't need to remember that. It's just, you need to know that if you trade this. And for the energies, they're all complicated terms like that. For things like the financials, it's just some date, like the 3rd Friday in January. But for these, it's different. Now, in this case, the last trading date for our December 2019 crude oil contract is November the 20th. So it's on that date that you have to offset or you have to figure out how you're going to take delivery. The delivery date or period is by arrangement anytime in the month of the contract. Now that means that if you take delivery or make delivery on this crude oil contract, you have to contact a dealer in Cushing, Oklahoma and arrange to have pipeline delivery or accept pipeline delivery of 1,000 barrels or multiples of that of oil. And of course you do that only obviously if you're in the oil business. The retail trader can't do that. And the delivery location is various named locations in Cushing, Oklahoma, or pipeline access to TEPCO or Econ Pipeline Company. So if you have access to either of those 2 pipelines, you can make or take delivery on crude oil. If you don't, you can't. So again, that's not relevant because we get out of the contract before delivery is an issue. All right, let's go back. So these are the things you have to know. And this is going to be an exam question, obviously, because if somebody says, well, what do you need to know to trade a futures contract? You say, well, mostly the margins, the contract size, obviously, and if it's relevant, the delivery date and delivery location. Typically, when I ask a question, I'll say it's a financial contract, so there is no delivery, so there's no relevance to the delivery date or location. So really what you need to know is the maintenance margin, the initial margin, and the contract size. Those are the big 3, right, obviously. Okay, margins and leverage, just to make sure you understand this. It should be clear from what I've said that you can trade an $80,000 contract with about 1/20th that amount of money in cash if you're willing to accept the risk. And that will be typical for these contracts. The leverage varies considerably from one type of contract to another. On the foreign exchange contracts, the leverage is as high as 50-1. So the British pound contract that I trade, the leverage is 50-1, for example. On oil, it's about 20-1. So let's establish exactly what we mean by that. We said, this is a repeat of what we already know, the initial margin is the amount of cash per contract that you must have in your account prior to trading. And then if you go into the contract, that cash is earmarked and can't be used for other things. The maintenance margin is if the amount of cash per contract falls below this value, you get a margin call and must replenish your cash balance if that's an issue. The notional value of the contract is the contract times size times the price. So if we're talking about $57.64, then the notional value of a single oil contract is $57,640. So it's that contract that has the $4,400 initial margin and $4,000 maintenance margin. The leverage, the maximum leverage available, the maximum, is the notional value of the contract divided by the initial margin. So the maximum leverage you can get on the oil contract, by example, given that the notional value is $57,640 and the initial margin is $4,400, is 13.1 to 1. So that means if the price of oil goes up by $1, the cash in your account will go up by 13 times that amount, or the other direction. Now that's the maximum leverage, and never, unless you're crazy, do you try to get the maximum leverage, because that's simply too dangerous. But this implies that if you control the amount of cash in your account for futures, you could get exactly the level of leverage that you want. And that's what's going to be critical for ETPs. Because remember, we were curious about how we get these 2x ETPs and 3x ETPs that said if the S&P goes up by 1%, we guarantee ours to go up by 3%. They're obviously using futures contracts, and they're getting leverage on those futures contracts to get that 3-to-1 rate of return. This indicates that maybe they could write an ETP that gets 13-to-1 leverage, technically, but they wouldn't do that, of course. So leverage is the ratio of the notional over the initial margin. Also, it's useful to know how much a penny move in the underlying affects your contract value. Every penny move in the price of oil affects the margin account by $10 per contract. The price of oil goes up by a penny, your margin account changes by $10. We'll see why here in just a minute. Now let's go back and look at some of these contracts again, but this time let's look at the margins and the leverage, because now we understand what that means. And we're still looking at the sugar contract, and we don't have the oil contract here anymore because we want to move over now to a discussion of the contracts we're likely to be trading. That doesn't include sugar. Sugar's in here because it's used as an example in the textbook of the extreme volatility swings that you get in these markets sometimes. But the rest of them are something we might trade. We've got 3 S&P 500 contracts. We've got the Euro FX, and then we've got the E-mini, then we got the micro. And then we have the 10-year U.S. Treasury note, which we know, of course, a lot about now because we know why these values on those contracts rise and fall with changing market interest rates. But first, let's take a look at the 3 S&P 500 contracts, if you can see that up there. Now, it used to be there was only one, and that's the big one, the S&P 500. 250 times the S&P 500. That simply means that the notional value, which is used to establish end-of-day settlement, will be equal mathematically to exactly 250 times the daily close in the S&P 500. And so if the daily close in the S&P 500 was 3,083.40, this is for the near-term spot. Let me rephrase that because that's only true for the near-term contract. It is equal to the daily close in the futures price of that contract, And so here looking at the most recent S&P 500, the daily close of the futures price, which is not necessarily the same as the daily close of the S&P 500, because this is a futures price, was 3,083.40. The initial margin for that contract is $33,000. So you can't trade that contract without $33,000 cash. That's why this contract was only for, obviously, professional and institutional traders. You would never think of one contract that has to have $33,000 in cash. The notional value of that contract is nearly $1 million, $750,000, $770,000, with an implied leverage of 23-to-1. Now that is the massive contract that is used to trade against the market as a whole. It is that contract that was involved in the collapse of the market in 1987, when the market lost a third of its value in 1 hour, because of the huge trade being done of this futures contract versus the actual S&P 500 on that day. And this, of course, is the oldest and most established of the future contracts for financial. This is the famous SPX. And professionals always trade SPX. You say, that's too bad, I would like to trade SPX, because basically it's a bet long or short on the S&P 500. So if you have a sense of directional, then maybe you could trade this. Well, you could consider trading the E-mini S&P 500. That's been around for many years. It's the same exact contract, except it's priced at 50 times rather than 250 times, so it's 1/5 the value of the S&P 500 contract. It has a notional value of $154,170, but the maintenance margin on that's only $6,000. Now that you can handle. And you say, well, I can't handle it. Maybe you can. $6,000 is still more than I have just to trade, for example, one contract. Well, a couple of years back, to make this market accessible to small traders like yourselves, and you can trade this, they introduced the micro E-mini S&P 500 contract, and that is 5 times the S&P 500, and it has a maintenance margin of $600 and an initial margin of $660. So in other words, you can trade with the big boys for $600. You can get into long or short S&P 500 for $600 maintenance, $660 initial, and the notional value of your contracts is $15,470. And if you maximize your leverage, which you shouldn't do, the leverage is always the same on this because they're proportionate, is 23 to 1. Now, this means, therefore, if you say, well, I don't know if I'd want to take a bet that's 23 to 1, because that means a 4% move would wipe me out or double me up, literally, right? That's quite a bit. A 4%, that's a one-day move. That's kind of a rare one-day move, but a one-day move could double me up or wipe me out, a 4% move. So what if I got 10 to 1? Well, if you wanted 10 to 1, then you could achieve that with about $1,200, $1,500 cash in your account. That would give you about 10 to 1. Because the leverage you get is actually the cash committed as a reserve for this contract divided into the notional value. The maximum, of course, is the minimum cash you have to have, but you can set any amount of cash you want. I tend to trade about 7 to 1 on my futures trades. So I have enough of cash in the account to cover about 3 or 4 margin calls, basically, which is never going to hit. And so you have, therefore, the choice of 3 contracts, and small retail traders can trade the bottom one. And most people to this day still don't know that. There's no reason to be trading SPY if you're trading directional bets when you can be trading SPX futures contracts, because they're so much easier to trade. And they also give you the full range of the dates you can trade. The same thing is true when you go to Forex. Don't ever, by the way, open a so-called Forex trading account, F-O-R-E-X. That's a scam for the largest part. It does not operate fairly. It does not operate with the market. You are allowed to execute your trades on a Forex account on a rapidly moving market only after the exchange that you're trading on has positioned themselves to where they won't be hurt by any trade you make. Forex is junk. If you're going to trade foreign exchange, you trade in CME Group futures contracts, because that is at the action right there. You're just like anybody else. You're trading right on the wire. So you've got the big contract for the euro dollar, the Euro FX contract they call it. That's expensive. It's $141,000 worth of euros, and not too bad. It requires a margin of $2,000 more or less, right? $1,800, $1,980 for the initial. But the little contract, the micro down there at the bottom, that requires $180. So if you want to bet on Brexit, you bet on Brexit through this. Have about $400 or $600 in your account. You can bet the pound versus the dollar, or you can bet the yen versus the dollar. Or you can bet the euro versus the dollar. Again, the margins are tiny on these micro and micro E-mini contracts. By the way, the terminology, for whatever reason, is not consistent. On the top, they call the E-mini the mid-size one and the micro E-mini the small one. But on currencies, they call the E-mini the mid-size one and the micro without the E-mini the small one. So that's why it's written that way. That's what they actually call them. So this means that for many of the more modern financial contracts, your entry into it is entirely accessible at the retail level. And I tend to tell young aspiring students who are trying to get used to these markets, you should actually start with futures rather than with options or with stocks. Because the futures are actually easier to play in some respects if you think you have a sense of economic movement or direction or something like that. It, for example, has been relatively easy to make the Brexit trades because it's based off the news cycle for the largest part. And then finally, we have the 10-year Treasury note. You know, that's going to be based upon interest rate expectations. So that's a big contract. They don't have E-mini versions of that, unfortunately. $128,000 notional value. You have 90-to-1 leverage, on the other hand, for that contract, because the size of the contract is $128,000. I mean, $128,000 with a $1,300 margin. So that's absolutely massive leverage for that. But the two that should interest you potentially are the index, the S&P 500, and the foreign exchange for macro. Now, here's an important point that nobody knows out there, except for people who actually trade these contracts fairly often. When you go to buy a stock, like DTIL, for example, one of the new risky pharmaceuticals, then you know if you buy $10,000 worth of that stock, the moment you make the trade, the cash in your account goes down by $10,000, and your 100 shares of stock appears on the account. Obviously, you buy a put or call option. If you buy a put or call option, then the cash in the account goes down by the size of the trade. If you write one, the cash in the account goes up by the size of the trade, although it's restricted. You can't take it out until you offset the contract. When you go long or short in a futures contract, it does not affect the cash in your account. It leaves it unaltered, because unlike stocks and options, when you go long or short in a futures contract, you are not acquiring an asset and you are not selling an asset. You instead have entered into a contract to effectively agree to acquire an asset in the future, or to deliver an asset in the future, which is different. Therefore, the cash in the account does not change when you go long in the contract. You have to have a certain amount of margin in the account to do this, but that margin amount doesn't disappear when you go long in the contract. No cash disappears. The margin requirement says the cash has to be there, and it has to stay there. That's what the maintenance margin says. Now, here's an example. Again, you are not buying an asset, you're not selling an asset. Instead, effectively, what you're doing is you're beginning what is called daily settlement. Now, here's a trade I made last year about this time, and it's a good example. See at the top, this was a natural gas contract, and I went short in this. This was the opening trade, SLD, one $4.30 NYMEX contract. This pretty good sized contract. And it doesn't say what the notional value is, but it's, the margin was $44,000. It looks like the value is $44,000, all right? So one NYMEX contract short. Okay, so take a look at where it says before, and that is a picture of the status of the account before I made that trade. And you can see in this account, there's a gold holding, there is a Dropbox holding, and then there's cash for $44,820, right? Then I went short in the contract, and it's reflected where it says after. After, you see it up there, it says NG whatever, and then it says -1, minus $42,000. The notional value of that contract was minus $42,998 because it was short. But notice at the bottom, the cash has not changed. It's different by $8 because because that's the transaction fee of buying the contract. But the amount of cash in the account started at $44,800, and it was $17 different after the contract was over. Now, if I had bought something worth $44,000, such as $44,000 worth of stock, then the cash would be zero. But it's not zero. It's $44,000. So going into the contract, long or short, in this case it was short, does not affect the cash in your account. It just begins the process called daily settlement. Now, the cash in the account will thereafter change because of daily settlement, and it will change every day until we exit this contract. But when we exit the contract, there's no cash added to the account or subtracted from the account at that time either. The process called settlement just stops for the last time. Now we'll look at an example of that so you can clearly understand it. If you don't get this about futures contracts, you know nothing about futures contracts, right? This is complete ignorance about futures contracts unless you understand what this point is here. It does not affect your account. You say, well, the margin on that, according to that sign there, was well, the maintenance margin was 5,806. Now that means that I was committed to holding at least 5,806 of those dollars in that cash account. I could not allow that account to drop. Now, with that cash, I could have bought more stock, could have done anything I wanted, but I could not allow the cash value to drop below 5,806. That was the maintenance margin on that contract. They would not have allowed me to trade anything that would have drawn the cash value down. Now you notice, or you don't notice, but you can probably guess, I of course would never let the cash get anywhere near the amount needed for a margin call on this. It's also the case, as is clear here, that when you're actually trading, the cash is held against all trades, not just futures trades. You have an account. In that account, you buy and sell stocks. You buy and write options, and you buy long or go short on futures contracts. There's one cash account for all of that. And so the maintenance margin and any calculation you might make for leverage, which is fairly arbitrary, comes off of that single cash account that is used for all your trades. All right? So it's just the cash in your account. So when they say you have to have an adequate maintenance margin, then that's tallied against the total amount of cash you have in your account. Now, settlement is how this works. Unlike options, futures are not paid for, which is to say the commodity to be delivered is not paid for until the delivery of the commodity. And so if you offset your account and don't take delivery of the commodity, it's never paid for. And that's normally the case. The buyer of the future, however, is required to deposit funds in a special margin account. It's a special margin account in the bookkeeping entry sense that your broker knows what the value is and will tell you you can't let your cash drop below that, all right, which is at the end of each day adjusted to reflect the capital gain or loss in that futures contract. The starting required balance for this is called the initial margin. The seller is also required to maintain a margin account that is adjusted daily, and that's your cash account. And if the seller does not own the commodity, may have to meet special requirements. The account balance must always be kept above the maintenance margin, and the maintenance margin is, by some brokers, called the day margin, if you hear that term. Now, this example of our oil trading account is everything. This is an arbitrary example of the way settlement works. And this slide is absolutely something you have to understand, right? If you don't understand this, you don't really understand very much. So this is us going long in our crude oil contract that I'm using as an example. And then we imagine that certain prices happen in the days that follow, and we ask the question, how does that affect the cash balance of our trading account after settlement? So here we are at the top. We have $5,000 in our account, and we're calling that the margin account. Or maybe we're earmarking $5,000 of our $42,000 in our own internal books as the margin for this contract. It's more than we need. Remember, the margin on this is $4,300. On day one, midday, we go long on this account at $56.74, the price we've been using. That triggers off that we have now our long in an account that has an initial notional value of $56,704. There's no gain or loss, and far more important, this transaction does not affect the cash in our account, because it doesn't. As I point out in the chapter, there are fees for doing this, so of course those are reflected. They may be $10 or $8 or something for a $50,000 trade. They're next to nothing, but there's a tiny charge for the fees. They're not here because we know they're there, and it would complicate this too much to show a $17 fee for a $56,000 trade. Now, the first settlement is at the end of the first day, right? Because in midday we got this for $56.74, but there's always end of day settlement. So at the end of the day, we'll say crude is dropped to $56.52. The notional value of our account is now $56,520. That's a $220 loss, and so that amount is deducted from the cash in our account, and the cash in our account is now $4,780. So even though when we move into this contract, it doesn't cost us anything to do it, thereafter, money is put into or taken from the cash account by the settlement process at the beginning of the trade, at the end of each day, and then finally at the end of the trade with the offset. So we continue on the second day. It's still working against us. The price goes down to $56.48. Our position now is worth $56,480. That's another $40 loss. So $4,740 is what remains in the cash account. Our cash is going down. This continues through the third day and the fourth day. And on the fourth day, we've actually dropped our cash below the margin because we brought it down to $3,280. And there was a margin on this, a maintenance margin of $4,000. This is below that. We're ignoring that here because we're saying this is actually part of a larger account with adequate cash, so there's no margin call here necessarily. But if this were the only cash, there would be a margin call here. But on the fifth day, we kind of get a turnaround, and the price spikes up by more than $1, and we get a $1,320 capital gain because now it's going our direction. And the cash account is up to $4,600. And then finally, on the sixth day in the morning, this goes up above what we paid for it. We decide to exit at $57.02. That has a $57,020 notional value. That gives us an additional incremental gain of $680. And that puts the margin up to $5,280. And we've made a $280 capital gain. And we're done. Now, there will, of course, be a settlement at the end of day 6, but that's not relevant for us because we settled out with our offset trade in the morning. So we're out of this. So in a nutshell, when you go long on a futures contract or short on a futures contract, it is an agreement to begin the settlement process, which is initiated at the bid that you win when you get into the contract, long or short. It ends when you offset with that ask, and thereafter you're done. And the only other time that you have a settlement is obviously at the end of the day. So that natural gas contract that I showed you earlier, even though this one here, even though $44,800 and some is where we started, as the price of natural gas came down, it did come down in this case, then the cash account in that account rose. So when I finally got out of the contract, then it was done, and I had a capital gain of a couple $1,000s. And it was over. If it went the wrong direction, we had a capital loss. Right now on the pound contract, the current contract I'm in, which is 10 micro contracts, is down about $1,200. It's the third set of transactions I've made. The first two are profitable. This one's going to be a loser. But the others, this one loses about 60% of the gain on the second one, and I had a pretty good sizable gain on the first one. I stayed in the contract too long. All right? So each 1 cent move affects margin by $10. So that's it. That's how futures contracts work. They affect through daily settlement. So that you have to have absolutely crystal clear for the exam and to understand how these are. Now, what if you take delivery? What if you take delivery? Now, normally you don't. We wouldn't, of course, but what if it's oil? We're actually oil traders and we actually do want to take delivery. Or we're natural gas traders. We want to take delivery on gas. So how would you do that? Okay. Now, if you go long, and we'll use the long example, on a futures contract for $57, if you take delivery, you will end up paying $57 for the price of oil, but not directly, indirectly. and this is what people don't understand about futures contract. The net cost will consist of two components. The price you pay at delivery will be the spot for that day, no matter what trade you actually made. But the results of the daily adjustment to your margin account, whether a capital gain or a capital loss, when added to that, makes the effective price on the delivery the same as you contracted for on the day you went into the contract. Therefore, I've got to change this. This is incorrect. $57, not $59. I could proof these things 1,000 times, and I still don't get it quite right. 57. 59 was last year's example. Okay. All right. Okay, here's why. Here's what happened on this contract. Now, in our example on settlement, we decided to offset after 6 days because we're speculating. Suppose we were oil traders and we did not want to do that. We hold the contract all the way to expiry because we actually want delivery. That's this example. So we're not exiting on the 6th day. So we start off the same way. In November, you buy a December crude oil futures contract for $56.74 with a value of $56,740, and you're long. You want to take delivery because you're an oil trader. Spot price on the day you enter this contract is $55.82. That is not relevant to anything, but that is just happens to be true. When November the 20th arrives, let's say spot has risen to $59.04. So what are the settlement terms? Okay, you take delivery of the oil in December at the November 20 spot, the day of the contract, which is $59.04. You do not pay $56.74, you pay $59,040. In other words, you pay the same exact amount as you would have had you never done that futures contract, because you pay spot just like everybody else. And you're saying, well, wait a minute, what do you mean? You pay spot in November for December delivery? Yeah, that's the way oil works, and a lot of the big commodities work that way. You pay the price in November for December delivery, right? Okay, so you take delivery of oil at spot. You have gained, though, $2,300 in your margin account because you held that account until expiry. And expiry, it was at $59.04 because the futures price has to converge to the spot price at expiry. And on the last day of trade, the futures price will be the spot price. And so the exit price for you is $59.04. Because of that, your margin is $7,300, and your capital gain in the margin account is $2,300. So you pay $59,040 for the oil, the same as anyone else pays for it, but you have a capital gain of $2,300 in your margin account. So the net cost of oil to you was $56,740, which is essentially the same as exactly the price you contracted for in the futures contract. All right. Now that's subtle, but it does not mean that you, when the oil is delivered, pay $56.74 for the oil. There is no market out there that allows that. There's only the spot price delivery. This also explains why, therefore, you don't have to take delivery if this is true, right? You could be a Bakersfield oil company out in Taft with no access to Cushing, Oklahoma pipelines, and it affects you the same way. If the spot happens to be $59.04, then effectively you can buy or sell this for $56.74 because spot is $59.04 in Bakersfield, just like it is in Cushing for light sweet or whatever, and you have the capital gain in your account of $2,300, so it doesn't matter whether you make or take delivery of oil, even if you're in the oil business, because all of the adjustment is in the futures contract, which any small trader or large trader can trade or have. That's why these markets work so well. It does not require you to take delivery to take advantage of the fact that you were right about the market, see? Okay? So it's all done, therefore, through the capital gains and losses on settlement. So a few notes on this. The example is for long, but you're just as likely and just as easy to go short. If you are an oil driller, then you're likely to be short, right? Because you're selling oil, you're not buying oil, so you're going to be short from that position. If you're Starbucks, then the position on coffee is going to be different if you're a Panamanian coffee grower, right? In Starbucks, you may be going long on the contracts. Panamanian coffee grower is going to be going short on the contracts. If you are a sugar producer in California, sugar beets, then you're going to be long on your contracts, or short on your contracts, I should say, but the confectioner is going to be short on the same contracts. So it depends on the business you're in as to whether you want to be long or short. Bid, ask, and limit orders, you'll pay close attention to the bid-ask queue, which is similar to level 2, and you use a limit order. It's always the case you use limit orders. For all of the trading, they work exactly for futures as they do for stocks and options. Now, with futures, you have implicit leverage, which at maximum is the notional value of the position divided by the initial margin. But nobody trades at maximum. You create your own leverage by managing the cash portion of your account. That's what ETFs do, as we're going to see. If you are guaranteeing DOG 2x negative Dow, and you know that DOG has that promise, right? How would you do that? Oh, it's really easy. You just short these very same Dow futures contracts that we're talking about, and you short them such that the notional value of the account is double the amount of cash you have in the account. And that gives you exactly 2-to-1 leverage, which you pass on to your investors, as we'll see by example. So the leverage will effectively compound your gain or loss by the scale of leverage. Effective leverage equals the notional value divided by the cash in your account, or the cash you've set aside in the account associated with those trades. So even though you can get 23-to-1, you may desire 6-to-1, so you trade such that the cash to notional value is 6-to-1 when you start, and that's exactly the leverage you're going to get on the account, long or short. Exiting the contract. Less than 1% of all futures contracts in with delivery. You do your trade with an offset. It's just like options. Basically, you buy to open if you're long, and you sell to close if you're long. You sell to open if you're short, as I did on that natural gas contract, and you buy to close if you're closing that, and that's the offset. The opposite is the offset. And it works the same way as it does for option. Futures price must converge to the spot as the expiration date approaches, and open interest declines until it's 0. Long positions exit about the same pace as short, so open interest is gradually cleared off by the exchange. But remember, you did not buy or pay for anything when you get into a futures contract. You agree to daily settlement terms which have been satisfied. When you offset, you do not sell anything or get paid. You just inform your broker that you're closing out your trade, and the exchange says goodbye and you are done. And that's it. ICE allows contracts allow either futures or cash settlement instead of delivery, even if you don't offset. Most contracts are cash settled only. So most non-commodity contracts no longer have delivery, so offset is automatic, which is to say at 4:30, whatever the time is on the last day of trade, whatever the price is, that's your final settlement, and you're done. Okay? So this is the current, this is current oil. Level 2 looks just like it does for stocks. And this is the one we're actually trading, the British E-micro. You can see there the multiplier is 6250, and the margins on my account are 734 initial and 587 maintenance for this account. Now on this account we've got $40,000 in the account in cash, so the margins are of no relevance when that's true. But the multiplier is only 6250, so the The big contract, the multiplier is 62,500. So in other words, what we mean is here I'm effectively buying 6,250 British pounds, whereas for the big contract you'd be buying 62,500 British pounds. So in my contract, a penny move is $62.50. The notional value of my contract is $8,107. For the big contract, it's $81,070. And as you can see, the margins here are trivial, less than $1,000. So I'm typically trading 10 contracts at a time, so the margin requirement for that's about $6,000, $7,000 with a $40,000 account. So it's no possibility of margin calls, okay? So for the small trader, sometimes this is where you get started. You get started in foreign exchange, not the Forex accounts, those are bullshit. In an actual futures account at a real brokerage, those are the real ones, like this right here, or the micro E-mini index accounts, like the S&P 500, the Dow, the Standard, small cap, that stuff, okay? So when we come back on Wednesday, we keep this up. Or no, yeah, Wednesday, right.